Hello, good evening. My chief host, Professor Saliu, kindly confirm that you can hear me clearly. Also, reconfirm that you can see my screen being shared. Today, we continue with our discussion on option theory. Yes, we can hear you. Thank you. Many thank you. Now let's go on to the business of the day, option theory and valuation. I've gone to voice notes so as to explain as much as I could the principle of option theory. I say recap quickly is that an option is a right to buy or sell an underlying asset. This asset could be categorized into two. One is what we refer to as financially traded assets, or they could be referred to as real capital investments. Our financially traded assets include your stocks, your shares, your bond, or your currency. Then we can also take option valuation to real capital investment. Now, when you are required to value option, okay, let me take my screen off. That has been explained before. The put option, the call option, the premium computation, definition of premium. We have the practice to option contract has been explained. The money has been explained. Now we have explained also the point of the Black School option pricing model. Now let me quickly take the Greek, the Greeks, the Greeks. Before I go into question, the Greeks is the sensitivity of option value with respect to changes in the input variables. Now we call that for you to determine the value of an option, you require five variables. One is the underlying asset price, denoted with what? XO. The second is the exercise price, denoted as your E. The third is the risk-free rate, denoted as your R. The fourth is the time to maturity, denoted by letter T. Then we have the volatility. The volatility is your standard deviation. Where you have these five variables, you can value either a put option contract or a call option contract. When we say the call valuation, that is the premium you are expected to pay if you are buying a call option, or the premium you are expected to pay if you are buying a put option. I also established the fact that currently Ican wants us to know the Black School option pricing model. I explained the Black School as the model for determining the fair price or the theoretical value of a put or call option contract based on at least five parameters or five variables. Those variables are listed. Now let's look at the Greeks. The Greeks is the measure or the sensitivity of option value with respect to changes in the input variables. Now, it measures a change in option price where there is a change in what any of the input variables. We now have under the Greeks, we have one of the Greeks is what we call the delta. The delta. The delta measures the relationship between change in option price with respect to changing the price of the underlying asset. Look at it, the Greek, sorry, delta is a measure of change in option price as a result of change in the price of the underlying asset. Now, with respect to Black school's model, data can be approximated as follows. The data of a call option is ND1. This I stated in my voice notes. The data of a put option is ND1 minus 1. And the data of an asset is 1. Now, what we call data neutral hedging. Data neutral hedging. I also try to explain this in my voice notes. Data can be used as an hedging tool. A data neutral position is one whose value does not change. Please highlight it. Which value does not change in response to changes in the value of the underlying asset. The primary objective of data neutral portfolio is to combine a position in the asset with a position in option so that the value of your portfolio does not change. Now, when we get to computation, I will demonstrate this. Other Greeks we could have, because the examiner could ask you to explain some of these Greeks. We have what we call the gamma. Most of these terms, of course, they might be coming new to us, but we need to get to understand it because it could be tested. One of them is the gamma. Gamma measures the amount by which data value changes. Let me highlight that. Gamma measures the amount by which data value changes as a result of changing asset value, as a result of changing asset price. Let me check. There seems to be a comment coming. Okay, please recap. Gamma measures change in asset, change in data value. Network is seizing. Which one do we have? Change in data value as a result of change in the asset price. Gamma is the same for both call and put option and is always positive. What does it mean? Where data value is, where there's increase in asset price, there's going to be increase in data value, and there's going to be increase in your gamma. It's positive. Now let's look at the next Greek. We have data. Data is the change in the price of an option, change in option price brought about by change in time to maturity. Change in option price brought about by change in time to maturity. The data is calculated as change in option price as a result of change in time to maturity. That is data for us. Finally, we have real. Real. Your real measures the sensitivity of option price to interest rate changes. Real measures sensitivity of option price or option value as a result of change in interest rates. Real is always positive for call option and negative for put option. Meaning that if you value a call option, when there is increase in interest rate, there's going to be increase in your call option value. is positive. When there is decrease in interest rate, there's going to be decrease in your call option value. But for puts, it's a negative relationship, meaning that if there's increase in interest rates, there's going to be fall in your put option value. And if there's decrease in your interest rates, there's going to be increase in your put option value. It's a negative relationship. Now the last one is what we call the Vega. Vega. Vega measures change in option price for a given change in the volatility of the underlying asset, meaning that change in option price as a result of change in volatility, change in option price as a result of change in risk, as a result of change in your risk level. Oh, you are too fast. Okay, I'm sorry, Olayinka. I want to try to at least resolve two questions today, tonight. Sorry if I'm a bit fast. Okay, a summary of what I've explained. I've explained data has changed in our option price as a result of change in underlying asset price. I've explained gamma. Gamma is change in data value as a result of change in the underlying asset price. I've explained data. Data is the change in option value as a result of change in time to maturity. I've equally explained real. Your real is highlighted. I've explained real as the change in option value as a result of change in interest rates. I've explained Vega as the change in option value, option price as a result of change in volatility. You recall that you have 5 variables to compute option value. Let me repeat those variables. You require the asset price. The asset price is denoted by letter X, X subscript O. You require the exercise price. The exercise price is denoted by letter E. You require the risk-free rate denoted by letter R, and you require your T. Your T is the time to maturity. That is, if you enter into a contract today, a contract to buy an asset at a price called exercise price in the future. Okay, I will recap on Gamma. Let's assume our company, First Choice Limited. We have an we have taken a call option on Zenith Bank shares. We have obtained a right to be able to buy Zenith Bank shares in 6 months' time. Then your T is 6 months' time, time to maturity. The option will mature in 6 months' time. Now, so as the students here, I should recap on Gamma. Gamma measures change in data value as a result of change in asset price. So that is here, Gamma measure change in option value as a result of changes in the price of assets and the underlying price of the assets. And gamma is always positive. Gamma is the same for both call and put options. That if the asset price is increasing, then the data value will increase. Positive relationship. If the asset price is falling, then the data value will fall. Positive relationship. That is what we're trying to explain. Now, to appreciate what we have discussed, that we can use data to hedge. Now let me play a small scenario before going to question. Imagine first choice. We have investment in First Bank here worth 100 million naira. And we understand the fact that the share price is always fluctuating. It's not fixed, it's not constant. As of today, our the naira worth of our investment is 100 million naira. Then we are not sure what the price will be, say 3 months time, say 6 months time. We are now afraid that look, how do we hedge against volatility in our share price? We can decide to go and hedge at the option market. We can decide to hedge at the option market. Of course, what do we require? Since we have the shares already, you are a bit away, please, you are a bit far from your microphone. Okay, I'll try, I'll get closer. Now, you recall that already we have these shares and we are looking at selling the shares in the future. We are not sure what the price will be if it's going to worth 100 million. We now try to buy a put option contract, right, to be able to sell our share at a price agreed now, but the sale will happen at a future time. We obtain the right today. We have hedged. Now, the option market will compute the premium and say, this is the premium you are going to pay so as to obtain this price. First choice, we now say, okay, yes, let's pay the premium. We now wait for like 6 months. We're now going to watch the stock market. If the asset price is increasing, what do we do? Are we going to sell? No. If the asset price is increased, if the asset price is more than the exercise price, let's assume we have obtained that right for 15 naira per share. And in 6 months' time, in 6 months' time, First Bank shares worth 100 naira per share. What are we going to do? We just walk away, we exercise our rights. Because if you exercise your right, you are going to sell at 15 naira. And we're making a loss. Are you there? Now let's take video administration. Let's go to question proper. Let's go to question. We have addressed this question last week. Let's look at question number two. Question number two, let's look at it quickly. Examiner says, discuss briefly the meaning and the importance of the terms delta, beta, vega in option pricing. This question is coming from HCCA. Discuss briefly. Then we can discuss that briefly, I'm sure. Now look at the second part of the question. Look at the second part. Assume that your company has invested one. Assume that your company has invested in 100,000 shares of Union PLC, a manufacturer of light bulbs. You are concerned about the recent volatility in Union share price due to the unpredictable weather in the United Kingdom. You wish to protect your company's investment from possible fall in share price until winter in 3 months' time, but do not wish to sell the share at present. No dividends are due to be paid by Union during the next 3 months. Market data: Union current share price is 200 kobo. 200 kobo. The call option exercise price is 220 kobo. Time to expire maturity or time to expiry is 3 months. Interest rate annual is 6 months. Volatility of Union shares is 50% standard deviation per annum. Assume that option contracts are for purchase or sale of units of 1,000 shares. Required Sorry, there seems to be a network issue. Now, can you hear me now? Yes, okay. Can you hear me now, please? Please confirm you can hear me. All right, fine. Let's go on with it. We try to manage it. This is one of the challenges when it comes to network, to manage it. Now, let's go to the question. Look at the question we are trying to solve. Look at the question we are trying to resolve. Oh, sorry, I have to undo that. The question we are trying to resolve. I've read this question before. We have the market data stated. Let me check my chart. Oh, fine, yes, good. Now let's go on to the solution. Examiner say devise a data edge that is expected to protect the investment against change in share price until winter. Data may be estimated using ND1. Now come here. I try to explain data. Data measures change in option price as the value of the underlying share changes by 1%. Now the first thing you need to do, okay, that is the explanation for this is the A part. Definition of data, and bigger as required by the examiner. This is response to the A part of the question. Please note the highlighted is response to the A part of the question. Network is a bit of challenge. However, like I said, we won't subscribe to limitation. We will go on and see how best we can manage it. Now, let's go on with the question. Now, the first thing you need to do is to compute your ND1. Now, you start by looking for your D1. Look at the formula for our D1. Now, quickly define your variables. Your SO is the underlying asset price. Your SO is the underlying asset price, which is given as 200 naira, sorry, 200 kobo. The exercise price is 220. Your time to maturity is 3 months. Your interest rate is 6% and volatility is 50%. Look at the variables as defined. Our SO 200 kobo, our E 220 kobo, our risk-free 6%. 3 months is prorated to give us 0.25 and our volatility 0.5. Next is to substitute these variables into your D1. You have your in, the formula SO, your SO is 200, your E is 220, close the bracket, plus your risk-free rate is 6%, your volatility is 0.5, that will be square, divided by 2, multiplied by your time, all over your volatility multiplied by the square root of your time to maturity. Now, please, like I said, get your calculator. I expect you should have your normal distribution log. Network is enemy of progress. All right, please reconfirm that your ND1, your D1 is negative. Your D1 is negative 0.1962. Please, I need you to reconfirm. Applying your calculator, please reconfirm that your D1, you are able to get negative 0.1962. At least I need some students to reconfirm this so that we can proceed. We have gone through this before. Confidence. In your calculator, you use your in bracket 200 over 220. Close the bracket. We walked through this last week. We walked through this confidence. We walked through this last week. The application of your calculator in calculating your D1. We walked through this last week. Can we reconfirm that we have negative 0.1962? Please reconfirm. All right, let's go on. Like somebody commented, the network is enemy of progress. We are going to overcome limitation. Yes, we are going to overcome limitation. We can be there. Now, can we confirm that we can use our calculator to compute this? Has anybody been able to compute this? Syntax error. Badmos. You should not have syntax error. Yes, Veronica has confirmed. No, I can't compute it. Yes, I have Deborah confirming also. Oh, great. Oladimeji has confirmed also. Please, because of time, maybe those that cannot confirm, that cannot compute, we meet outside it so that we can maximize our time. But when your computation is correct, you must have negative 0.1962. Now, once you compute your D1, the next task is to compute your ND1. You recall what I said, where you have your D1 to be negative, immediately you introduce 0.5 minus is a standard. When you compute your D1 and you have negative, you immediately introduce 0. 0. Where is it? Yes. Look at what I'm saying to. Look at where we are going to. This is where we are now. You introduce. Let me create a sheet here so you can see. You want to compute ND1 using the standard normal distribution table. You want to compute your ND1 using Somebody will help you later. Building, we need to move on. Now, we want to, using our normal distribution table, we want to compute ND1. Now, you recall, our D1 is negative minus 0.1962. As soon as you have negative, introduce 0.5 minus, then open a bracket. Now, go to your normal distribution table. Check 0.1 under 9. What do you have? 0.1 under 9. When you check your normal distribution table, you are going to get 0.0753. Please, can we reconfirm you have this figure? I expect us to have our normal distribution table closer to us. Can we reconfirm that? Oh, great. Neji, somebody has confirmed that. Great. Fine. Now, you now put your plus. Just to come here, you put your plus. Now, you know we have checked up to 0.9, sorry, 0.1 under 9. You are left with 0.62. Now, you bring your 0.62 back. Look at it, 0.62. 0.62. You now open another bracket. Now, please go and check. 0.9, sorry, 0. Okay, now 0.2 now. Because after 9, the next thing is 0.2. Look at the figure we are trying to read. 0.2 under 0. What do you have? You are going to have 0.0973. 0.0973. Please, can you confirm you have this figure? Okay, somebody has confirmed that. Now, how do I get my 0.6? 0.62. Look at it here. You know, the first thing you check was 0.1 under 9. Abi? You check 0.1 under 9, right? Under 9. Up to, look at my highlighted. You are left with what? 6.2. Look at this. You are left with 6.2. You now introduce 0.62. That is where you have this 0.62 coming. The figure you are trying to read from your log is between 0.1, 0.1 and 0.2. Look at this highlighted figure. This figure lies between 0.1 and 0.2. So you are going to take 0.1 under 9, which is the lower band, and you look for 0.2 under 0, which is the upper band. Let me check. The second reading. Now check 0.2 under 0. Jumoke, please check 0.2 under. What do you have? Yeah, somebody has confirmed that. I can see confirmation from Nuruddin Adams. This figure we are trying to read. Look at the figure we are trying to read from our log. This figure lies between 0.1 and 0.2. The figure 0.1962 lies between 0.1 and 0.2. What you do is that you take 0.1 under 9. That is your lower band. Now take 0.2 under 0. That is your upper band. Look for the difference. Now, if you take this figure computation, if you work this figure out, you are going to get 0.4222. This is your ND1. This is your ND1. And that is the delta value of a call option. Oh, great. This is coming from Farida. Now, please confirm that you are able to calculate this 0.422, which is our ND1, that represents the delta value of a call option. Let me check if there's a confirmation from the audience or from the students. Oh, great. Modupe has confirmed that. Okay, thank you. Now, note the delta of a call option is ND1. At times, the examiner may give you expressly in the question, or you may be required to compute it. Now, look at this. Look at this comment. In order to protect against fall in union share price, we create a portfolio of shares of Union PSC and a call option on Union PSC such that the delta of the portfolio will be zero. If you look at my voice mode, I said the total delta must be zero. Create a portfolio. You call a portfolio. A portfolio must have at least two investments. Look at this portfolio. If the number of calls needed is X, look at our portfolio. You create a portfolio, security, the security, the quantity, data per unit, total data. Recall, we have, look at the shares. Shares is your asset. We have 100,000 shares in this company. And I said the data of a share is constant, is 1. The data of a share is constant, is always 1. The data is 1. Now you multiply the quantity by data. This will give you 100,000 for shares. Now come to your call. I need to adjust this. S should have been here. Just 1 minute, please adjust on your side. This S should have been here. The data value should have been here. Our X, capital letter X. Okay, good. We can now continue. You can continue. You denote your call. Number of calls to be purchased so as to data H by letter X. And we have computed that the data of our call is 0.4222. You multiply your X quantity by the data, that gives you 0.4222X. And you recall I said your total data, the addition of all the data must be equal to what? 0. To data H, the total data must be equal to 0. Let me look at my chart. There seems to be some common chart coming in. Let me see. Check your network. My network is fine here. Badmus, please look at your own network. My network is fine. Now look at it. The total data is equal to 0. The question is, what is X? Our concern is what is X? That is, how many calls do we need to buy so as to data H? How many number of calls do we need to buy so as to what data H? So what is X? Solving this using collecting light terms, what is the value of your X? Of course, you are going to move. When you move to the light term, this becomes negative 100. Our X is equal to negative 100 over 0.4222. Please divide. What do you have? You have negative 236,855. Please, can you confirm? Oh, okay. No, the examiner says, okay, somebody is asking, Veronica, how do we know the edge is call or put? Now, the examiner specify here. Look at here. It said, look at the question, part of the question. It said, look at it. Market data. Can you see it? It said, call option exercise price. That means he wants you to take a call option to hedge. In some questions, the examiner will not specify, but you now look at it. If you are trying to sell, right to sell is a put option. So without being told, you need to do put option. If you are trying to buy, right to buy is a call option. Without being specified, okay, if the examiner says the customer is planning to buy shares, is planning to buy shares in the future, then you remember that okay, right to buy is a call option. Or if you say the customer is planning to sell his shares in the future, right to sell is what? Put option. So it can also come. At times the examiner can be specific. At times the examiner will now create a scenario that will provide a guidance on whether you require a call option or a put option. That is fine. Now let's go back to the solution. Let's go back to the solution. Look at it. Now, please, this sign is very important. If you look at this figure, you have a negative figure here. Negative. Now look at the comment. Because the figure is negative, we need to sell 236,855 call option contracts. Can you see it? When you compute your figure and you have a negative sign, it means that you need to sell. I repeat, when you compute your figure and you have a negative sign, it means the customer needs to what? Sell. We need to sell three 262,588 call option contract. And if you take it that examiner says 1,000 call, there's a clause in the question. You can leave your answer like this. Examiner will mark it. Or if you look at a clause in the question, there was a clause in the question. Examiner says, let me take you back to the question quickly. Examiner says, look at this place. Assume that option contracts are for the purchase or sale of units of 1,000 shares. So if you want to take that into consideration, if you want to take that into consideration, you simply divide your answer by 1,000. Approximately, we need to sell 237 call option contracts. We need to sell 237 call option contracts. Whether you leave your answer like this or the other way around, the full mark will be awarded. But it is very important to say that we need to sell. Negative sign implies selling. And if you have computed and you have a positive sign, it implies what? Buying. We need to buy. This point is very, very germane. That is the response to the examiner. Let me look at any other part. Okay. Okay, look at it. Look at this place. Comment upon whether or not such edge is likely to be totally successful. 2 marks. That is this edge computed likely to be totally successful? Let me go to it quickly. Look at the comments. Look at the comments. A edge such as this is only valid for a small change in the underlying share price. As the share price changes, the option data will alter and the edge will need to be periodically rebalanced. What we are saying is that this edge will only be valid if there is a small change in your share price. Where you have a very large change in your share price, this computation will not be valid. It's expected that the share price will not fluctuate radically, maybe like just a small percentage change. But when you have a very big change in the share price, this computation, this edge will not be valid. That is the implication. Let me quickly look at the chart. Yes, yes, Jumoke, that 1,000 value is fixed. So if you are required to data edge in the exam, don't stress yourself too much. If you want to data edge, require three things. One, the assets, which could be your share or stock. Recall, the asset data is one, is constant, doesn't change. Then your call. The data of a call is ND1. If you are giving an exam, good luck. Just pick it and move on. If you are not giving, compute your D1. You start from your what? Compute your ND1, sorry. ND1. The data of a call is ND1. Why is this edge only suitable for small change in price? The position is that if there's a radical change in your stock price, the delta edge will need to be constantly what rebalanced. Why? Because the variable used in computation, look at it, your interest rate is not sure that it's going to remain constant for the next 3 months. Are you there? Two, your volatility is not sure that it's going to remain constant. All the variables used in computation, they are based on estimates. Estimates may not reflect the actual when it comes the future time. So Stanley, why is because your computation is based on estimates. Please, the 0.5 you introduced to this figure, was it added or deducted? The 0.5 will come first, minus. That means your 0.5 minus other figures coming. If you have a negative D1, assuming you have a positive D1, then 0.5 plus the figures from, let me take you back to that so that you see it. Look at your 0.5. All these figures, all these figures will be deducted. Oh, sorry. All these figures will be deducted from phone is programmed to, let me minimize it. All right. The phone is programmed to pause, so sorry for that. Now let's go on. Now the question is, all these figures will be deducted from your these figures. These figures that we derive will be deducted from 0.5. That is the standard. That is how the is designed. So you know you are working with a model. So that I try to minimize out. That model is built by two authors, the Black schools. Two authors. They have propounded a model so as to value either call or put option. Also note that we are not saying this model is what completely error proof. You know, a model is based on assumptions. Some of the assumptions might not, some of the assumptions, in fact, most of the assumptions in reality will not stand. For example, you assume that there is no tax. Is that possible? You assume no transaction cost. But the model is to provide us a way to value future transaction. We have a parameter to say what is the likely value of this asset. Nobody, you know, most of the things we work with investments. When we get to that, we discuss it. If you look at your investment, okay, let me pause here so that I don't go out. Because I need to also explain that when we get to application of option to rate capital assets. Now let me quickly take. I have 1 hour. Okay. Now I want to take a step into the application of option theory to real capital investments. I want to quickly explain at least two. The application of explain the equation and what we intend to get from the equation. Okay, what we intend to get from the equation is the ND1. Which equation are define? This equation, right? What we intend to get from here is our what? The delta of a call option. The delta of a call option. That is the intention. The delta of a call option is approximated as your ND1. And funny enough, this is not the first time we solve this ND1. Last week we did. For fun, we can still explain the equation. That for you to look at this equation, it started from D1. You have to get your D1 first. And I said when you compute your D1 and you have negative sign, you immediately introduce 0.5 minus. It's a constant. It's a constant. Now you now go and read from your log. And we have read, and at least like 2, 3 students have confirmed this up to this point. So I need to quickly, so that we can actually maximize this time, I need to explain the application of option theory to real investment. Now, you know when we define option theory, I said option is defined as the right to buy or sell an underlying asset at a predetermined price called the exercise price at a known future date. Now that underlying asset could be financially traded assets, your stocks, your shares. The two questions we have solved are regarded as financially traded assets. You can also take, I'll come back to this please. You can also take option theory towards what we call real physical assets, that is capital investment. Now the application of option theory to capital investment, we have four aspects. We have option to abandon, option to delay, option to expand, and the valuation of equity as an option. Now, I want to quickly explain at least two tonight. Let's look at option to abandon. Now, let me take your mind back to capital investment projects. When a company enters into capital investment projects, let's say the investment will take like 5, 7 years. The intention of the company is to see that project to a logical conclusion. The company enters into an investment project in year zero. And that year zero, you are going to commit financial resources, which we call outflow or your initial outlay. Year one, you now estimate. Year one, you have inflow. Year two, you have inflow. Year three, you have inflow up to like year five. Now, the only thing the company is sure of is the initial outlay the company is committing. The only thing, draw my system closer. Okay, I'll try. Draw your system closer. The only thing the company is sure of when you make that investment in year zero is the amount you are committed in year zero. Your year one value is an estimate. Your year two value is an estimate. Your year three, year four, year five, they are all estimates. In fact, your discount factor that you are using is an estimate. Now the question is, if a company has committed money to a long-term project, investment project, and in year one, year two, project expectations are not met, should the company continue with that investment or should the company abandon? Let me take an illustration. A company has committed 50 million to a project. That is in year zero. In year one, you expect inflow from that project. Maybe you expect that year one, you should have 20 million inflow. Year two, you expect 15 million inflow. Year three, you have 30, 40 million inflow. But your year one, you only got 1 million inflow. Your year two, you got just 2 million inflow. This means this inflow. Should you continue with that project or should you abandon the project? You're not achieving your project expectation, maybe because of inaccurate data, or it might be that the business environment has changed materially. Now the question is, should the company continue that project or should they abandon? This is the concept of what abandonment. Where a company has committed financial resources to a project and project expectations are not met, should the company continue the project or should the company abandon it? Where there's an opportunity for abandonment, that means the company can exercise its right to abandon that project, meaning you pull out of that project. Let me give a good illustration to this. Look at if you recall when we started GSM telecommunication, we started with, let me take Airtel. We started with what? We started with Econet. A group of investors came to Nigeria, started what? Econet investment. After a while, what happened? The investor pulled out. Another buyer came in. What is that? They abandoned it. Another buyer came in. We have the era of before we get to Airtel, we have one before them. Different buyer are just coming in into that project. Now, the point which you have to take tonight, option to abandon is treated as a put option contract. Option to abandon is treated as a put option contract. Now, at times you might go into a capital project. The capital project on its own is not financially viable. The capital project on its own is not financially viable. But when you look at the option to abandon, that if I enter this project for like 1 or 2 years, as opposed to staying till 5 years, I could just pull out. Option to abandon is treated as a put option contract. Now I want to demonstrate, because there's no point explaining without demonstrating what we are doing. I want to quickly take illustration to this, if you don't mind, because I'm aware of time limitation. Please, let's take a slow look at. No, I want to look at this question. I want to demonstrate with this question. Yeah, look at option to abandon. Yeah, look at it. Please let me demonstrate my explanation with a question. Look at this option to abandon. Swiss Company Limited is considering a high-risk project with the following after-tax cash flow. Look at this. When initial investment is 930 million, look at the project inflow from year 1 to 5. The risk-adjusted discount rate is 12%. The company has recently received an offer from a foreign investor to buy the entire project for 620 million at the start of year 3. At the start of year 3, the cash flows from the project has a standard deviation of 36%, risk-free of 4%. The examiner says, using the option pricing method, assess the financial viability of this project. Assess the financial viability of this project. Now let's go to it. If you have a question coming to you like this, neighbor, you have to first compute the normal NPV. You are going to compute your traditional NPV. Look at the computation of traditional NPV. I like to take this together. I wanted to be on the same page. I just wanted to be on the same page. I don't want to slow down and front. Now let's look at it. Let's compute our NPV. This, I'm sure everybody will run through this normally. Our initial outflow in year zero. Look at the inflow. Discount discount factor at 12% for year one. For year zero is 1. Now quickly run through your calculator. You can reconfirm our discount factor from year 1 to 5. Now if you check your computation, you have a negative NPV, which implies that if the company starts the project immediately, this project is not financially viable. Meaning, if you take this project from year zero to completion, this project is not financially viable. That means ordinarily we shouldn't invest in this project. Ordinarily, switch company limited should not invest in this project at all. That is, if you take this project from year zero to completion, it's not financially viable. Now let's now look at option pricing valuation to capital investment appraisal. They require 5 variables. Now, examiner says we can exercise a foreign investor is willing to buy at the beginning of year 3. You now take your year 3. Look at it, they are highlighted. Recall you require 5 variables to value option. And I said option to abandon is treated as a put option contract. Option to abandon is treated as a put option contract. You now come here. The present value of your cash flow from the time the investor is willing to buy, say you want to buy from year 3, you are going to add the present value to year 5. That becomes your SO. Look at it here. I put it here. The present value of cash flow occurring from year 3. Year 3 is the year the investor is willing to buy. Up to year 5, that is the maturity year, the end of the project. You are going to add it. The addition will give you your XO, the asset price. The addition will give you your XO. Is that taken? That becomes your asset price. Now, the price at which the foreign investor is willing to buy. No, it's not a must for you to sell, right? It's not a must for you to sell. It's called the exercise price. It's called the exercise price. It's called what? The exercise price. Look at it. And we have been giving our risk-free rate as 4%. Our volatility is 36%. That is 0.36. Now your T. Examiner says the foreign investor will be coming in at the beginning of year 3. That means after year 2, you want to dispose the investment and pull out. You want to abandon. You are going to run the investment from year 0 to year 2. After year 2, you pull out. You dispose the investment if you wish. That is, you want to abandon it. That is, you dispose it to another buyer. The another buyer here is now willing to offer you. Look at the time that I'm going to invest in this project. Year 0, year 1, year 2. After year 2, I'm going to abandon. Abandon means I'm going to sell this project to a foreign investor. Your time to maturity becomes what? 2 years. Once you've been able to define all these variables, next is to go and do your valuation. I said that valuing option is not very difficult. Your skill is to try to identify variables required. And you require 5 variables. The asset price measured by SO, the exercise price measured by E, your R, that is the risk free, your volatility, and your time to what? Maturity. Once you have this variable defined, once you have all these variable defined, once you have this variable defined, you now go to your computation. Recall, we said option to abandon is treated as a put option contract. So we are going to calculate the value of a put option contract. Option to abandon is treated as a put option contract. We are going to calculate the value of a what? Put option contract. We start from your what? Calculate your D1. Please, somebody should apply the calculator. All the variables are given here. Calculate your D1 and confirm that your D1 you have 0.6182. Confirm that you have 0.6182. Compute your D1 and confirm that you have 0.6. You have all your variables stated. Our XO is computed as 688.27. Our E is 620. Our risk fee is 0.4. That is, sorry, 4%, 0.004. Our volatility is also stated. Please, can we reconfirm that we have this figure stated so that we can move forward? Now, while I'm waiting, once you have your D1 confirmed, you go to your D2. Your D2 is D1 minus our volatility multiplied by the square root of our time to maturity. All right, thank you. Femi, thank you. Once you get your D1, proceed to compute your D2. Also reconfirm that your D2 you have 0.1091. Your D2 you have 0.1091. Once you have this confirmed, sir, 0.5 is missing from your D2. Today we are going to summon the problem. Like I said, network is an enemy. Now we are back, please. Let's go on with the question. We are back. We continue to make it. In spite of any limitation, we are going to overcome it. We have the mindset to overcome limitation. Now, as soon as you have completed your D1 and D2, once you are done with your D1 and D2, what is this? Now you now proceed to compute using your normal distribution table. Go and compute ND1 and ND2. Now, look at our D1. Let me try to space this. Look at our D1. We have points 0.6182. 0.6182. What do I say? Once you have a positive figure, you introduce 0.5 plus. Veronica, can you see it? Our 0.5 plus or minus will be introduced at okay, we can take that as Veronica, can you see it? Our 0.5 plus or minus will be introduced when you get to your ND1. When you get to your ND1. Now, because the figure here is positive, introduce 0.5 plus. Now, can we go to our normal distribution table? Check 0.6 under 1. What do you have, please? 0.6 under 1. What do you have? 0.6 under 1. What do you have? You are going to get 0.2291. Please confirm that you are fine. Thank you. Now, we now move to, we have read up to 0.6 under 1. You have left with 0.82. 0.82. Look at it. Plus 0.82, which is the remaining figures from here. 0.82. Open another bracket. Now go and check 0.6 under 2. 0.6 under 2. You are going to get 0.2324. Once you have that figure, let it for 0.2291. The upper band figure, your upper band will be deducted from your lower band figure. Now reconfirm that when you take this calculation, you have 0.7381. 0.7381. Okay, I will come to that, Veronica. 0.81. I'll respond to you on that later. I will respond to you later. Understand what you're saying? I'll respond to you later. Now that's you guys confirm. Now when you get to your ND2, look at the figure for our ND2. Our ND2 is 0.1091. Now it's a positive figure. Introduce 0.5 plus. 0.5 plus. Now open a bracket. Check 0.1 under 0. You are going to get 0.0398. 0.0398. 0.0398. Please confirm that you have that figure. Once that is confirmed, you are left with 91. The last two digits. Now plus 0.91. Now you now go and check the upper band. 0.1 under 1. Correct? If negative, you introduce 0.5 minus. Yes, you get it. iPhone, you can get the solution. This was shared. This was shared yesterday, sir. This material we are using was shared yesterday. Maybe you were not in the group, or you missed it. This was shared yesterday, but you can get it after the lecture. You can get it after the lecture. It's available after the lecture. Now, when you have this figure confirmed, 0.0 under 1, you are going to have 0.0438. Deduct it from the lower band. Deduct it from the lower band. Right? Now, if you take your computation fully, you are going to have 0.5434. 0.5434. 0.5434. Now, when you confirm that, correct, thank you. We now move to, now, we are trying to value a put option. Look at it, note. Option to abandon is treated as a put option contract. Now, this aspect I have to bring it to. Look at it. If you remember the formula, if you recall the formula for valuing put option contract, if you look at it, and this was discussed or was shared, look at it. The formula is your E, exercise price exponential R exponential minus RT multiplied by N bracket minus D2, everything to brackets minus SO multiplied by N bracket minus D1. That means I cannot stop in my ND1 and ND2 because I require N minus D2 and I require N minus D1. To compute your N minus D2 is simply 1 minus ND1. Look at it. To compute your N minus D2, sorry, is simply 1 minus ND2. I repeat, to compute your N minus D2 is simply 1 minus ND2. And we have computed our ND2 as 0.5434. We have computed as 0.542. So just 1 minus your ND2. That will give you 0.4566. 0.4566. You can check it from a calculator. And to compute your N minus D1 is simply 1 minus ND1. Is simply 1 minus ND1. So 1 minus ND1 will give you 0.2682. Once you have this computation, you can now value your put option contract. You can value your put option contract. Like we are aware, most of this will come with formula. And good enough, Ican will supply this formula in the examination. Although you need to familiarize yourself with how to use it. It's not sufficient to say the Ican will give you. You must know to use it prior to the exam. Now let's look at our put value. Let me space this. Look at our put value. Our put formula is stated. So what you need to do is to bring those variables in. What we need to do is to bring those variables in. Your E is the exponential. Your E, your E is the exercise price. Your big letter E is the exercise price. Your big letter E is the exercise price. Our E is the exponential. The exponential function on your calculator. You have my bracket minus, what is our R? 4%. Our time to expiration is 2. Close your bracket. Multiply by your N minus D2. Multiply by your N minus D2. Your N minus D2 is given. You close your bracket again minus, what's our SO? Our SO is given as 688.72. Multiplied by N minus D1. Your N minus D1 is also computed for you. Please work out. the value, if you put your computation, your calculator to work, the value of your put option is 76.6 million approximately. Please reconfirm. No, 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 no. And BC, is it BC? Khadija, you shorting your name. Khadija. Khadija. Our put value is not the put call parity theory. No, 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 no. The put value is given. Okay. When do you know when to use put call parity? Let me quickly explain that. Now, you can first of all calculate your call in this question. You can calculate your call value first. When you calculate your call option price, you now use your call option to using your put call parity formula to determine your put price. What I'm saying is this: our put call parity theory, our put call parity theory is a theory used to determine call price or put price when you have when one of them is given. That is, assuming I know my call value, my call option price, I can determine my put option price. Or if I know my put option price, I can determine my call option price using put call parity theory. So please, you should not mistake it. Now you can, like I said, you can work from your call option value to put, or you can work from your put option value to call. You can also go straight. What I just simply do here is to just go straight to value my put using the put option value. If you look at the start of that lecture last week, I stated the two formula. The formula for call price, the formula for put price was stated. The two value was stated, clearly stated. So, but when to use the call option, the put call parity theory, you can use this. If the examiner says calculate the put option price, and you are giving calculate the put option price, and you are giving the call option price. Are you there? Or the examiner say calculate the call option price, and you are giving the put option value. If you go to the definition of put call parity theory, it said it defines relationship between puts and call prices where certain conditions are met. And I try to explain that the put call parity is the fundamental parity relationship between call option price and the put option price. It states that where certain conditions are met, there is a fixed relationship between call price and the put price. So let me not digress too much out of this question. Maybe I will explain that again with voice notes so that I don't want to digress too much out of this question. And considering that I'm looking at the time. Now you have computed, please confirm that you have computed your put option price to be 76.6 million. If that is confirmed, now NPV with put option. Look at it. To compute NPV with put option towards abandon. NPV, like I say, compute your NPV with option to abandon. Compute your project NPV with option towards abandon. Look at it. You are going to have the value of the call option. Sorry, the value of the put option, 76.6. Now, NPV without call option. Therefore, you are going to introduce it to it. MPV with put option, that is MPV with abandonment option, is 70 million. Meaning that where the abandonment option is taken into consideration, look at it, thus the abandonment option has significantly increased the value of the project. Now you are not going to comment that the company should invest in the project. The company, please put your comments. The company, the company should invest in this project. Company should invest in this project and take take advantage and take advantage of the abandonment option. Take advantage of the take advantage of the aban abandonment option. Abandonment option. That should be your comment to the examiner. That after 2 years, the company should abandon it and take up and make their profit. That is not a must when you enter into a capital project. You wait until maturity. Provided that investment gives you opportunity to abandon. You have entered into a capital investment project and it gives you the opportunity to abandon. This is the treatment of abandonment option. If I draw your attention back to last direct question, the compulsory question is tested on abandonment option. Last direct question, the compulsory question was tested on abandonment option. This is not to scare us, but that let's try to prepare our mind for any eventualities. I have 10 minutes to take out of this class because I must be out of here by 5 minutes to 9. Another class will commence by 9 o'clock. So I need to also look at what question I can address within just 10 minutes. Let me explain option to delay. Within the time available, there is no way we can take the question fully. Let me explain option to delay. Poor audio. This should be coming from you. My chief host can hear me clearly. Please, Farida, can you check your own system? Better now? Okay, please try to check. I'm 100%. In fact, it's trying to warn me that this is too high. Okay, better now. Let me quickly explain option to delay. Where a company has exclusive rights to a project. And you know when you say a capital project, these are long-term projects. And most of the variables you are working with, they are actually based on estimates. You cannot 100% you cannot 100% predict the future. Let's take an illustration. A company has gotten an exclusive right. Look at Dangote Petrochemical. Dangote has gotten an exclusive right to commence petrochemical business in Ekpe zone. Now, government has given Dangote, let's say, 20 years patent rights. Go into oil exploration at our Ekpe zone. Now, Dangote now have gotten this right. But it's not a must to commence operation immediately. Because you are not sure that if you go into drilling. You are going to get oil in sufficient quantity at that site, a processing zone. Dangote can say, okay, I've gotten a right for 20 years. Maybe I should exercise, I should delay for like 1, 2, 3, 5 years. Let me watch an event unfold so that I will know when to start my project. That where a company has an exclusive right to a project, and that project involves a great deal of uncertainty. Instead of committing money now immediately, the company can delay the project for like 1 or 2, 3 years so that you have a better understanding or a better view of that project. Now, when you have that patent price, you can exercise your option to delay for like 2, 3, 4, 5 years. Now, the bottom line you are going to note, option to delay is treated as a call option contract. Option to delay is treated as a call option contract. What do you require? You require 5 variables. The asset price, which is your EXO, the exercise price, the volatility, the risk free, and time to expiration. Let me take this small question. I expect us to look at it in 5 minutes. So that let me look at this small question. Look at this question. Now look at option to delay. FCA, a property development company, has gained planning permission for the development of a housing complex at Ikorodu, which will be developed over a 3 years period. The resulting property sales, less building costs, have an expected net present value of 4 million at a cost of capital 10%. That is, if you commit this project now, we are going to get the NPV on the project is 4 million. FCA has the option, FCA has acquired the land in Ikorodu. FCA has an option to acquire the land in Ikorodu at an agreed price of 24 million, which must be exercised within the next 2 years. Meaning that we might not buy this land immediately. Yeah, we can buy this land in 2 years' time at 24 million. Immediate building of the property of the housing complex will be risky as the project has a volatility attached to it, net present value of 25%. One source of risk is the potential for development of Ikorodu as a regional commercial center for the large number of professional firms living in the capital big city because of high rents and local businesses start. Within the next 2 years, an announcement by the government will be made about the development of the transport link to Ikorodu from outlying districts, including the area where FCA owed the land option concern. The risk-free rate is 5%. Now let's walk through this. What I require is 5 variables. My for your XO, I'm rushing because of time. Okay, let's look at it. Estimate the value of the call option to delay the start of the project for 2 years using the Glasgow option pricing model and comment on your findings. Quickly, you know that to value option to delay is treated as a call option contract. To value option to delay is treated as a call option contract. Let me go to the solution. In 5 minutes. The current price, that is your SO, is the present value of the project. Look at it. The asset if you are buying the land now, that is the out the asset price now, the value of the land or the cost of the land is 4 million, so 24 million. The present value of that project in 3 years time is 4. Add back, your XO is 28 million. Your exercise price is the price at which you can buy the land in 2 years time if you delay is 24 million. Time to exercise your right to buy is what? Is 2 years time. That is time to maturity. Examiner has given you the risk-free rate. Examiner has given you the volatility. What remains? Value your option to delay as a call option contract. Please value your option to delay as a call option contract. So just step to work. Calculate your D1. All these variables put to work. All these variables put it to work. What's our D1? If you check it out, your D1 is going to give you 0.8956. Your D1 is going to give you 0. I can't hear you, sir. Voice note on this question. I will try. I will try. I will try. Please look at option to delay. What we're trying to look at is the texted option to abandon last time. You never can tell. You can text option to delay this time. You compute your D1. I want to assume that you put a calculator to work. As soon as you compute your D1, compute your D2. Once you are done with that, proceed to your work. Use your normal distribution table to compute your ND1 and ND2. And you remember, when this is positive, once your D1 is positive, introduce 0.5 plus. Then read your figure. 0.8 under 9. Read your figure. Once you read your figure, you are going to get your ND1. You have your ND1. Once you introduce your figure to ND2, you have your ND2 computed. Once you have this, the value of option to delay is treated as a call option contract. Just introduce your formula for call option. Look at the formula highlighted. This should be the fourth question we are solving on option contract. Highlighted. So put your calculator to work. If you check your calculator, the value of your call option is 7.481. That is, if you delay this contract, if you commence the contract immediately, the company, I will send the material and solution, you get. I can't hear you. Olawale, you should be able to hear me. Oh. My chief host can hear me. And I'm leaving the next 2 minutes so as to allow the next class to commence. Are you there, please? Olawale, please, you should be able to hear me. I'm working with 100% of my voice, of my volume. Once you compute, this is the value of your call option. Now, look at the implication highlighted. This implies that at current time, the project has a value equal to its net present value plus the value of the call option to delay. That if you delay this project, if you delay this project for 2 years, your net worth is 11.48 million. But if you commence the project immediately, you are going to get a net value of 4 million. That if you can delay this project, what do you mean by delaying that? Government will have established the transport system. There will have been a road network to Ikorodu. If you commence now, there's no road network. Look at the final comment. The additional value arises because the option to delay allows the company to avoid downside element of risk. What are the risks? It is assumed that Ikorodu is still more of bush. where there is no transport system. That means if you commence the project now, the company will incur more cost. If you delay the project for like 2 years, government may have construct the road. Are you there? That road network will now allow you to avoid some risk. The value of the property will have appreciated. Are you there? This is the concept behind option to delay that. No, let me wait for like 2 years. That I will have avoided some risk, and that my value of my asset will have appreciated. I need to stop here. I need to thank the audience because I'm very sure that after this next week is your exam. Of course, within the limitation, we try to do our best. We have our limitation as a human being. Please pardon us for our mistakes. And of course, like I said, at FCA, we want to break the barrier that it is not limited to physical class. We should be able to address concern of clients outside Lagos. So we thank you, thank you. My chief host, thank you. Let me allow the class to run. We try to do a voice note while I explain it. Thank you for your time. As I move out.